I had the best Father's Day gift anyone could ever have. My actual Father's Day was pretty tame, but the reason it was tame is because we spent the day packing for my wife and kids to leave me for like 6 days. I'm by myself for 6 days, and for the first time in like I don't even know. I can't even remember a time I was by myself for 6 days.
My wife and kids packed up and left me for 3 days, literally just walked back in the door. And it was the most hellish 3 days you can possibly imagine, because I've got a 4-month-old puppy that's not potty trained. And I think dislikes me enough that she will literally try and poop in my shoes.
They do that when they're young, though. Like if you piss them off, they'll go and find something that they know is yours and just wreck it.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, and welcome to episode 4 of Drunk Real Estate. I am Kyle Wilson, also known in the industry as Ashley Wilson's husband, joined once again by my 3 lovely co-hosts, starting with Mr. Jay Scott. How's it going, Jay?
I am doing well. I'm excited recording this, and then I'm hopping on a plane for a Vegas weekend. So let's get this thing going so I can get my vacation started.
You used to be a bit of a poker player, didn't you?
I did. In fact, I'm going out to play a couple of the World Series events this weekend.
Ooh, well, good luck.
Thank you.
Hopefully we'll see you next week and you didn't win the jackpot.
The jackpot. I don't think they call it a jackpot, but that's okay.
Whatever. What's the winner get these days? Because I remember back in the day, it was the first one was Chris Moneymaker won the $1 million.
You get a bracelet and a lot of money.
And a lot of money. What are you drinking tonight?
Once again, because of my low-carb diet, I am drinking clear rum, a can of orange crush flavored clear rum. Again, no carbs, no sugar. Pick it up at your local, I don't know.
Is it buy one, get one free this way? Is there a Father's Day special? Is there a discount that anybody can get in there?
It's only been released in 6 states. Alcohol distribution is by state, so they're only up to 6 states. But yeah, pretty soon it'll be available everywhere.
Why don't you send over a couple cans to your co-host, and we'll try and give you an honest, on-the-air opinion of whether it's really good stuff or maybe it's piss water.
Done.
We gotta send them 10 flavors, so that could be the top 10 one week. We'll just line them up and we'll try all 10, and we'll rank the top 10 flavors. Mauricio, coming at you. How's it going?
It's going good, man. I'm technologically challenged today, but other than that, things are good.
Yeah, what are you drinking tonight?
I found this. I'm a big Camus fan, and we're drinking some. There's a new Camus out there for you Camus fan. The Camus Suisson from the Suisson Valley, I guess. The Walking Fool, and it's actually pretty darn good. Actually, it's a blend, and I'm enjoying it quite a bit. Way more than whatever Jay's drinking.
No doubt.
AJ, you got something going on right now?
Yes, I have my sparkling ice. So it's not just water. It is sparkling ice with coconut pineapple flavor. Very exciting.
Hey, AJ, how do you handle things at home when you don't have 135 assistants running around? Do you rely on your kids and your wife, or how does it work?
Yeah, it's rough. It's hard to get by. I have to turn on the iPad by myself, but I'm making it work. So I'll get through it.
Well, your kids are getting to that age where they probably know more about technology than you do.
They do, but they're teenagers, so
they don't want to help you.
Hey, Kyle, what are you drinking, buddy?
I'm gonna crack. I shouldn't say crack because I'm almost done. I got a little bottle of Blanton's here, kind of a go-to for me for drinking the bourbon. Getting close to the end. I want to finish it off so I can get a new letter. This is a letter T. So I've got a T and an N, and I got to fill out the Blanton so I can get my little rack going. So.
I feel like this is a Sesame Street episode.
Yeah.
Brought to you by the letter T. And
literally understood nothing he just said.
Well, no, it's a thing with Blanton. So like these little tops on the top here. So they're lettered, and if you get all the letters that spell Blanton's and you send it into them, they send it back a little like presentation box with all your letters in it. So
that's cool.
And a card that says "sucker."
Yeah.
Gotcha.
Well, I'm going for it anyway, even though I know I'm a sucker.
The secret code is Ovaltine.
Well, let's get going and talk some macro stuff and some real estate. So, at the end of last month, the Census Bureau actually released some new data and projections on population migration in America. Overall population growth was only 0.38, which is pretty low. Not as low as during COVID, which it got down to 0.16. But we weren't making babies, and we weren't letting anyone in the country then, so that makes sense. But many states, in particular in the South, it outpaced the national average. I'll start with Mauricio. Looking up at me like you didn't know it was coming. How should we be considering population trends when we're investing?
Wait, what's the topic again? We're talking about population growth? No, I saw the stat. It looks like it's rebounding. I saw a stat actually that said that 2023, halfway through this year, we're already at 0.5%. So we're on track to do 1%, which kind of makes sense after the COVID thing. But no, if you look at a population trend graph from the last, 50, 60, 70 years, you'll see that the population, not the population itself, but the rate of growth is declining significantly. And as you mentioned, it's almost getting to zero. And that's definitely a concern. But when I think of population growth, I'm thinking of two different angles to it. So I'll just touch upon those quickly, and I'm sure you guys have your thoughts on it first. So number one is the sort of, when it applies to real estate anyway, the traditional thought, when population growth really, especially when it's migration from state to state, that affects a marketplace, right? Obviously, when people are moving to a particular state and you have net positive migration, that's going to create some demand for that particular marketplace, which is going to increase the prices of real estate. So if you're looking to invest in real estate, you obviously want to be investing where people are going. But this interesting stat here on the population growth as a whole, what that's being affected on is the labor participation rate. So the labor participation rate continues to go down further and further and further. The last stat that I saw, which actually came from Joseph Wang, who just did an amazing presentation at Limitless where we were last week. Joseph Wang, for those of you who don't know, used to work at the Fed and actually was the one at the operations desk, meaning when the Fed does quantitative easing and does pull all those levers, Joseph was actually the chief guy who actually does all that stuff. And he was saying that, especially through COVID, we're about 2 million people short from the labor participation force, and that is a continuing trend. And so we're having less and less workers in the United States. And his position was that creates sort of an inflationary pressure, because now that there's a shortage of labor or the labor either goes down or stays the same, that puts pressure on wages. And he thinks over the next few years or decades that's going to create an upward pressure on wages. And what that does is it helps drive inflation. So one of his main points in this talk, he had about 4 or 5 different points, but one of them was the population aging, labor participation force going down. And what that's causing is, in his opinion, inflation to continue to be at sustainable levels over the next few years, which of course, if you're a real estate investor, not a bad place to be. If you think we're in inflationary times, you generally want to have some hard assets, and real estate is certainly one of them. So there's a couple of different ways to look at it, but the population, the decline, and by the way, that's not just in the United States, that's worldwide. Worldwide population is coming to a halt. I even saw some statistics on China that they're anticipating to be peaking, I think at about 10, a couple more billion, and they're going to peak at about 10, and then basically by the end of the century, by 2100, they're expected to be about 50% less population than they are now, maybe more. So just some
conspiracy theories say they're already declining, and China's just not giving us the data.
That could be true too, but they're just. I think they just got overtaken by India. India is definitely one of the highest growing populations out there. And if you look at the projections going through another 50 years or so, certainly by the end of the century, India is going to be overwhelmingly, from a population standpoint. China, as you guys know, have that one-child policy, so their population has been aging, and their birth rate, was definitely below or around 1 because of that one-child policy. And so they're now paying the consequences, and they're projecting. I mean, it's just math. I mean, it takes 20 years to create a new worker. And if you stop having babies today, you're going to see it, 20 years from now.
And it's not just inflation. I mean, inflation and workers is one side of the equation, and the one that probably a lot of people care about. But as real estate investors, there's another one that we really care about, which is we rely on population growth to drive demand for our units. And if we're seeing slowing population growth today, that means that in 18, 20, 25 years, we're likely going to see a whole lot less demand for our units, and that's going to drive down market rents. It's going to drive down the income that we're generating, and it's going to drive down the value of the real estate that we're buying. So a lot of people concerned in this industry that if population trends are starting to drop today, that in 20, 25 years, we could see a big hit to real estate values in the industry.
Yeah, and the only pushback I would give there, by the way, sorry, AJ, before you jump in there, is everybody's assuming that the average age from I think right now the average human man is about 71, 72 years old, whatever it is. But the advance in medical technology, there's a good chance that 20, 30, 40 years from now, people are going to be living a lot longer than I think the estimates are. And so that will sort of throw a little bit of a wrench into some of these population growth forecasts.
Speak for yourself, not me.
Do we want that though, is the question? Do we here's the thing, but by 2034, older adults, so over 65, are going to outnumber children for the first time in history.
Well, this is why it's the Social Security. Look at all these liabilities that we have. It's financially speaking, we may be talking, this is a great thing overall. We get to live longer, have better lives, everything else. But when you're talking about economically and financially, this is a huge problem, because the longer living, you take insurance, for example, medical care, and everything. After the age, or in the last something like 10 years of your life, we rack up basically all medical costs. It's the vast majority, right? Huge amounts of medical costs. And the earlier someone dies, the more limited costs they have. That's why a lot of countries don't like to do advanced care on older populations, because the cost spikes so rapidly due to the type of care needed. And so the premiums that are paid out, roughly, if you took your loss ratios, so if you're looking at medical care benefits, the loss ratios that are being driven by any medical or age group are largely driven, meaning the vast majority of the loss, 3%. That's it. And if you take a population that is over 50% of that population is over 50, they just can't even break even, right? So this is on actual groups in their healthcare costs. So think about that in the terms of a country, right? Your aging population moves up. Those costs then on society move past a point where you have more people pulling out the premiums than you have in, and they escalate towards the end of that. And so economically I think for people and us living, that's great. I'm with Jay. I'm not going to live that long, so it doesn't matter. But, for the majority of society, that boost and increase in age it's a big financial conundrum, because we are not replacing it. It's totally fine if you have a larger, younger generation coming in. You have more premium coming into the economy, the workforce, and everything else, so it counterbalances that. But once that scale gets skewed, that's when it starts to cause problems.
It's really supposed to get skewed too, and that's you talk about just productivity for the economy. You need working age people, right? And so currently the number of people ages 25 to 64 versus the number of people ages 65 and older. 65 and older is currently 34%. And they project by 2053, that's going to go up to 46%. So if you want to talk about Social Security, the whole Ponzi scheme of Social Security, of the people right now paying for the older people, I have no idea how that's going to work.
No, nobody does. The government does.
But it's obviously, no one wants to step in and say, hey, old people, by the way, we got to cut your benefits. Young people, we got to tax you more. That's not a very good political message to run on.
We're going to have this issue in other areas anyway. I mean, we haven't talked much about AI and automation and productivity gains, and I don't think this is the time to be talking about that, because that's a whole other discussion. But there's going to be a time in the not too distant future when we likely see a whole lot fewer people to fill the current jobs that we have, or a whole lot, say that another way, a whole lot fewer jobs for the number of people that are looking. And we could see a situation where there are a lot of people that are chronically out of work, and that's going to tax the system even more. I mean, basically everything we've said so far has been negative. So potential inflation from population decline, potential drop in real estate values, tax on social systems, fewer people to work. I mean, all of these are negative. So I guess the question becomes, how do we fix this problem? The one obvious answer is immigration. That fixes it, at least for us, if not for other countries that are losing people. But obviously, that's a hotbed issue these days politically. So do we tackle inflation here? I mean, how do we do that in a way that's nonpartisan, that everybody can agree?
I mean, immigration would, to be honest, would solve everything. If you want to talk about aging population, immigration would solve that. We bring in more children, more worker age. It would solve that issue. If you want to talk about inflation, typically the people who we're bringing in who for immigration, that's lowering the cost of, frankly, jobs that many people don't want to do, and so the cost of doing those things goes down. It to me, it seems like a pretty simple solution. It's just I don't see it ever happening.
And I don't think it's politically, though. I don't think it's everybody agrees on inflation. If you look at when the senators, both and senator and Congress, all of them are pro-immigration, right? The only hot point that ever makes it political is how you as illegal immigration. Outside that, though, I think all politicians, everybody, we need those more people. I mean, everybody agrees upon it.
Well, just make it easier to legally immigrate then.
Exactly.
I just went through it. So I literally just in the last 6 months got my U.S. citizenship. I've been going through it for 6 years. If you want to talk about shoe-in to actually receive U.S. citizenship, I have a 6-year-old and an 8-year-old, both American citizens, a wife American citizen, tap in. I should be able to get my citizenship. It took me 6 years to go through it. So if you look at me, think of these other people who are just trying to work their way in, how much tougher it should be for them.
Yeah, it's such a mess. It's so the whole thing, and I think everybody agrees on it. At the end of the day, we want people coming in. Everybody does. We want smart people. We want hard workers. We want good family people. We want, and the amount of people coming to this country too, for the vast majority, are people that want to participate. Right? I mean, when you look at these people, they are the bedrock of our country. They're they're all pro-gun. Oh, I'm excited to work. I'm excited to build a future for my family. It's frankly what a lot of America honestly has lost. And the immigrants, they bring that to the table. And I think everywhere that's only good. But we just have this huge bottleneck, like you're saying, Kyle, which is ludicrous that it would take you or anybody 6 years. That doesn't even make sense.
You know how this is all going to end, right? I mean, this is to your point, nobody wants to fix it. It becomes a huge political issue, and you got all these they're going to keep kicking it down the can. And you know what's going to happen is they're just going to keep piling on more debt to pay for, once those expenses go on, they're going to try and monetize it, and they're just going to create this debt problem bigger and bigger and bigger until we come to the, come to Jesus moment where, it's not going to be pretty. It's just another.
Who's going to if our population starts dwindling, who's paying for all this is the problem. If you look by 2030 is we're having an inflection point of just population decline. By 2050, we're leveling out at the projections say 0.15 of our population growth. Right now, the average birth rate is 1.64 or something. It's less than, it's right around 1.65 the last couple of years. And just to maintain our population, we need a 2.1. So the only way to fill that gap is immigration. No one's we've progressed as a society where women their time is their opportunity cost of having a child. How much their hours are worth is so much higher that they're having children later. They're not having as many children. It's not like our grandparents where we were having 5 kids per woman, or maybe Jay's parents. He's a little bit older than us.
Hey, listen, I'm at 4. I'm carrying my weight. It's all you slackers. Come on.
I'm breaking even. I just decided to break even and just have two. And so, but yeah, no, the fertility rate's definitely coming down for a bazillion different reasons. But then the question is, you're looking at the graph. Everybody's looking at the graphs. You see the tsunami coming in the next, however, Kyle, you're talking about 2030. I'm looking at more 2050 or 2100 or 2100 or whatever. But anytime it comes up, it's like, no, well, we've been promising these things. And like I said, I think people are going to be living longer and longer. Maybe we should do an episode one day on that. That's kind of a fascinating topic. But what happens when people start living to, instead of 75, 80, they start living to 95, 100? What happens when the centenarians become a much larger population? I did see an interesting thing I just saw today. I was at the store getting ready for this episode and getting this beautiful bottle of Camus at the store, and there was literally a 60. He may have been in his 70s already, and he was bagging groceries. I was paying for my groceries, and he was 65. I should have talked to him. I should have said, "Are you doing this for fun because you're bored and you have nothing going on, or are you doing this because you've been forced back into working because you're 65, 68, 70, whatever he was?" But it's going to be interesting to see what happens when people start living longer. What are they going to do? Are they going to start, delaying coming into leaving the labor force, or are they going to be, in such, not in the greatest of shape, and they're going to be draining more and more of our resources, and somebody's got to pay for that.
Well, and that's the problem that you just hit there. So the problem that we have with the extension of life is people look at it and you're like, oh, that's better. We can work longer. We can do all these. That's not how it works, right? It's not like you go 70 years old and you're out digging ditches because now you live to 100 instead of 80. And so one of the fundamental problems that we have with the extension of life today is you're not extending the workable years of a 30-year-old and the productive years as far as childbearing years. So you are extending, which economically speaking is the time when you're pulling out at that peak level, putting economically nothing in, right? And you're extending the biggest population out into a time frame of those years. If we extended, 30, 40-year-olds, they're going to have 10, 20 more years of being 30 and 40-year-olds, right? That's, economically speaking, that's a totally different situation. So the liability end of this, which started at 60, which, by the way, when that was first enacted and everything, nobody lived to that. It was like, that was so far above the average lifespan, right? Nobody was even expected to live to that far. To where now it's not only expected, basically the whole entire population does. It's rare if you don't. And that's the liability end that is being tacked on. It's
and the good news is we don't have to, one thing you can take a look at, I mean, luckily we're not the first country or the only country to ever have this issue. I mean, you just have to look at Japan, right? Japan's been struggling with this issue for a long, long time. And have they collapsed? Nope. How are they doing? They seem to be doing okay, but
not such a good example when you look at their debt.
What's happened in Japan over the last 20 years that I kind of alluded to earlier is their debt to GDP is skyrocketed and is at over 200% debt to GDP. Their central bank they're buying stock market. Forget about the treasuries that we're buying. They're actually buying stocks. I think they own some ungodly percentage of the stock market there. So, I mean, don't be surprised how much these governments and central bankers can kick this thing down the can. If Japan can be at 200 and what is it, Jay, these days? 220? I don't even know what the current Japanese, but they've been doing QE for 20 years. And again, I mean, it's on my bucket list to go have some sushi in Japan. But everybody that goes to Japan says, hey, everybody seems to be living a pretty normal life down there.
So I read an article today in terms of data that predicted in the next 50 years, the population of Japan is going to dwindle to 87 million people, of which...
What is it now?
I think it's close to 100. Of which 77 million are Japanese nationals, 10 million are foreigners. So literally like 1 in 8, 1 in 9 are going to be, more than 10% are going to be people that have immigrated to Japan. And I think they're expecting it. I think they're actually encouraging it because they recognize that they're going to have some major economic issues moving forward. I mean, obviously they had major economic issues in the 90s for other reasons, but they're going to be right back there if they don't do something about that in the next couple of years. and they seem to be encouraging immigration. And I think part of the issue here is it's not that we don't all agree that legal immigration is good for the U.S. The problem is the way we talk about immigration and the way we approach it. I think we're scaring a lot of people from wanting to move to this country. I mean, if it were up to me, if I were in the White House or if I were king, and I could make any rules I wanted.
Thank God you're not.
Thank God I'm not. No problem. No.
Hey, we don't want anyone from Florida running anything.
Fair enough. But let's pretend I was. I mean, I would take anybody that wanted to come into this country that seemed to be hardworking and of working age, and I would give them a social security number. I might slap an ankle bracelet on them, give them a temporary visa, give them a social security number, and say, you have 30 days to find a job and start paying taxes. And as long as you find a job, you're paying taxes and you're staying out of trouble, we're going to give you a path to citizenship.
No, but the U.S. right now is at like the peak of immigration. So we have, what is it, over 4,000 people a day are currently immigrating into the United States. Since 1980, the United States has had over 12 million people. And immigration has come in waves, sections. So immigration isn't like a standardized thing, right? You had the frontier expansion, which was all the northern European countries. They came over. It was roughly 110,000. A bunch of weirdos that were sheep herders like my family moved out to go out and explore the West. The industrial part was 7.5 million. Ginormous wave from Europe in the Industrial Revolution, right? Coming over. And then the next wave, which was the next period, which is essentially whatever that is, 1920 to 1970, like nothing. And then from 1980 to now, it exploded. And immigration has been rising every single decade. So I think that when we talk about it's either we're trying to, we're not being good to set a narrative or tone or people are immigrating here in masses. The problem is we just have a system that's broken to process them, take them in, do it right. And then we create liabilities through illegal immigration when they would have been assets if we just got them in legally.
So the question is that, so if we know all these facts right now, short term, it's easy enough, right? We still have certain states that are seeing huge population growth, and we just invest in those states. But if we see these longer term trends happening, and we know that no one's going to get their shit together and fix immigration, is this really changing your long-term outlook and how you're investing in things? Or do you think it's just going to be long enough that we'll wait until we actually see those cracks happen?
So I personally think that the internal immigration is far more important. We're at a point in the United States where we're like a tale of two cities, and the South compared to, you've got essentially Texas, Utah, New Mexico, Nevada, Idaho, they were all positive. Then you have California, and you had Florida that was positive, North Carolina, South Carolina, right? And then the Northeast decimated.
Don't ruin my top 10, AJ.
Sorry. I'll cut this off here. But for us out west, Texas has just been like a fire hose of immigration just going everywhere, and it's big booms in economies. And these aren't short-term things, right? We're talking about started in the 90s where this stuff started to go. But more importantly, immigration to me, interstate, is the type.
Migration.
Yeah, sorry, not immigration. Migration is the type of migration. And when you look at so the California system, one of the highest percentage of people that move out are people that are sucking the pensions. It's the police officers. It's the superintendents. It's everybody else. They're taking their $150,000 salary and they're moving to somewhere like Texas or Idaho, and they're living twice the life that they could have there. This is taxpayer funded capital, and it's being just poured out in other states. So right now, all these states, we've got this giant straw stuck into the side of California, and we're just sucking capital from, and two, it's not like it's just the businesses, just the people selling their houses and moving capital, the taxpayers that are actually paying for that stuff. And this is a really important component to that migration period is they're bringing, it's not the rich because the rich don't need to move. It's not the poor. It's the middle class, in particularly homeowners. They're selling, they're moving capital, pensions, things like that out. So the middle class is what's really moving. The wealthy, they don't need to move because they don't care about all the problems. They don't have to deal with any of them, right? And then the lower class, they're stuck, right? They can't move.
Right. So Jay, do you agree? Do you think this is something that for now we could just focus on investing in states that are getting the net migration, or do you think we should be worrying about some longer term effects? And I'll after this, I'll move on to the next topic.
I think we definitely need to be thinking about longer term effects. Certainly in the next 3, 5, 10 years, following migration trends in the U.S., I think is going to be fine. Again, if birth rates drop to zero today, it's not going to impact us as real estate investors probably for another 15, 20, 25 years. So it is a long-term concern for me, but it's not going to impact what I'm doing for the next 3, 5, 10 years.
Fair enough. That's some good insight. All right, let's move on to our next topic. In the news, we've been seeing some major defaults and foreclosures. And so the inner workings of private placements are actually becoming mainstream. It was kind of just a secret that rich people invested in. And now Fox News and NBC and all these people, or Wall Street Journal are reporting on private placements a lot more. So historically, the dynamics of general partnerships, running deals, and limited partners just investing money, it's been pretty smooth since investments have been pretty successful in the last decade since the Great Recession. But recently, we've seen a little bit of choppiness in private placements. So LPs are asking a little more questions. They're being a little bit more selective. So AJ, how are you seeing the dynamics of GPs and LPs work in today's market?
It's an interesting subject because first of all, when you're looking at the market phases during the downturns, right? That's when you're right, Kyle. That's when everybody asks questions, and that's when people get nervous because nobody thinks about it when they're getting checks. And the problem when you're an LP is that you are investing in an alternative asset. You are a business owner, and when you are looking at the merits of those investments, right? You have to understand that for the most part, you're either doing something short term, which you're buying, fixing, flipping, trading, selling, right, something like that. Now you're timing markets. And if you time it wrong, you're in real trouble. Or if you're doing it for more of a long term, then at some point in that, you're going to be in a down market. And that's going to hurt, right? And I think there's been a really lack of education for LPs on the fact that this is not an ATM, right? This is a business, and it's not like your W-2. It's not like a dividend that checks in. When revenues come in, when times are good, you get checks. When they don't, you vote, and you've got to have general partners that can manage through that. The problem was during the good times, it was really easy to get a lot of capital and produce very stellar short-term results. Very stellar. Had nothing to do with the GPs or anything else, right? And I think that created a little bit of a hubris amongst everyone, GPs and LPs. And now this happened in 2008, right? We saw this in 2008 when people were like, I gave my money to this person and it was going good. And then when it falls apart, then they're scammed. And I think this dynamic of up and down markets and GPs and LPs, meaning the general partnership, which is the one that has all control and makes decisions, the LP, which is a limited partner. This dynamic is one that's always Wall Street loves to bang on the private markets over. They love to do it. And during downturns, they say, this is the problem with private placements, right? Because so-and-so lost money. And Wall Street comes in and they have Wall Street Journal, you have New York Times and everybody basically saying this is bad or scary. Of course, when Wall Street loses, the economy, when they bankrupt the economy, that's fine. But when one LP that's a developer in Texas, the development doesn't go right, this is the most dangerous thing ever. And I think if you're an LP or a GP, looking at that relationship and making sure that you have a good relationship in there in understanding, first of all, is important, but it's also hard. And me as a GP, it's been hard, right, for me and others, because out of those investments, every single person is different. So all your LPs are different. So they have different financial goals. They have different overall amounts of capital, situations in life. And when downturns happen, LPs also get hurt. So some of them lose jobs, right? You lose equity or stock markets. Now you may need capital. And so it's a very dynamic period when you're in different market cycles. There's obviously when everything's making money, nobody cares. But it's really tested. GPs and LPs are really tested through downturns. And I think it's important for LPs to look at the general partnership and say, all right, who am I investing with? What is their strategy? Have they been through this? Do they have experience in this? And expect that there will be a downturn. And then two, that relationship as far as structure goes. So what are the incentives? Are we aligned in incentives, right? Or is there an incentive structure that may be off? And trying to make sure on an LP, looking at that GP and saying, so because you don't want all limited partners. All the GPs out here, you don't want all the money. Just because somebody will give you the money doesn't mean you should take it. An LP, just because it's a good deal, doesn't mean you should go with that general partner. It's a very important relationship, and you have to look at structure, but also the individuals that are in it and what they're trying to achieve out of it.
I think we have a bigger issue here, and that issue is that. And I think Mauricio and I are probably a little bit older than you guys. We remember like back before 2008 when economic cycles typically were 5, 6, 7 years. We would go through a recession every few years, and going through a recession every few years was a great way to kind of clean out the system. It forced GPs who didn't know what they were doing, who might have gotten lucky for 2, 3, or 4 years, to stop getting lucky and realize that, okay, this, as AJ used the term, an ATM, this market's not just an ATM. And so every 3, 4, 5 years, GPs would realize that they weren't the smartest guys in the room, and they'd take some hits and have to lick their wounds and figure out what they were doing wrong. Likewise, LPs every 4, 5, 6 years, they would start taking some losses because the market would turn against them, and they would realize that not everything's going to be a winning strategy. Problem is, since 2008, we had this, what's it going on 15-year run where GPs have been reinforced with this idea that they can do no wrong, and LPs have been reinforced with this idea that they're always going to make money and there's really no risk in the system. And that's been bad for everybody, because now here we are 15 years later, and for the first time, people are getting into trouble when they're like, didn't realize that this was even possible. And here's the crazy thing. It seems so obvious to me, and again, I've been doing this longer than a lot of people, but this whole relationship between risk and return seems to be lost on a generation of investors. It's not uncommon for me to talk to investors now, especially younger investors, who ask me what our returns are for one of our syndications. I give them a number, and they say, well, I can get 3% higher on this one. I'm going to go do this one over here. And I ask the question, well, why do you think that one's offering 3% higher? Well, it's a better deal. Well, no, it might be a better deal, but more likely it's a higher risk deal, because there's a relationship between risk and returns. And so many young investors don't recognize that inherent relationship between risk and return. They don't understand that the reason why treasuries pay 3, 4, 5% and real estate pays 10 or 12%, and these highly risky ventures might pay 30 or 50 or 100% if you're an angel investor. The reason is because the things that pay potentially higher returns are much higher risk, and you have a chance of losing money. And people don't recognize that there's a chance of losing money. And I think there's going to be a reckoning over the next couple years where GPs are going to start to recognize that they may not be as smart as they thought they were. They're going to start to realize that that the market has helped them tremendously, and LPs are going to start to remember or start to recognize for the first time that there's no such thing as a risk-free investment.
I think that's already happening, right, Jim? I mean, you always talk about the fact that people now, LPs, are really more concerned about return of capital, getting their sort of this. They're much more. They're paying a lot more attention to their security of their investment, right? They want to return, but before they were just looking at that top line number. Oh, I'm going to get 15%, 18%, 20%, 30%, whatever the number was. And now they're like, hey, am I going to get my money back? I want to make sure I'm not going to lose money. And I think that's just sort of the evolution. One of the statistics that I saw recently from the SEC that really, on the one hand, boggled my mind, but on the other hand, it makes a ton of sense. I mean, we've clearly been in a syndication bubble, for lack of a better word, over the last 5 or 6 years. Everybody and their mother is jumping in,
raising hundreds of millions with no experience.
Yeah, Kyle, your better half does a great job of explaining how most of these GPs, the vast majority of them, were successful primarily because of cap rate compression, because their real estate was going up, not necessarily because they were doing anything great with the property. In fact, a lot of the syndicators were actually missing their numbers. They didn't get their rents up, they didn't get their occupancy up, they didn't get their NOI up. But hey, when the property goes up 50%, it's like back in the stock market days.
Look how good I did.
Yeah, you could just throw a dart at the stock thing and you could win. The stat that I saw that blew me away, but also made sense, was that 70% of syndicators had less than 3 years of experience. 70% of syndicators had 3 years. And I think that's due to precisely what you said, Jay, which is usually you have a 4, 5, 6, 7 year cycle that kind of flushes people out. GPs get a little bit more conservative. That's been extended to at least double now, and it really hasn't happened. I mean, really, we haven't had any issues since 2008. So what is that now? It's coming on 15 years. And so I think you're already starting to see it. I think LPs are definitely starting to pay more attention as to who the sponsors are, what their track record is, what their level of experience is, all that great stuff. But I think people are starting to understand what risk-adjusted returns are, which is really what you should be looking at.
So my question that's happening right now is, of course, you're going to have those properties that just are failing right now and they have to fire sell or they have to do something drastic. But these other properties that just aren't performing as well as they normally do, these LPs have been expecting turnarounds in 2 or 3 years. We get double our money in 2 or 3 years. And now GPs are having to kind of be creative with, okay, I'm going to refi into a longer term debt. And we might have to hold this for 8 to 10 years instead of the original 2 or 3 years. Do you guys think there's going to be some sort of divergence between LPs and GP interests where the GP are making these decisions that the LPs are going to be like, well, that's not really what I signed up for?
Well, I think what we've seen over the last couple of years is, and the way compounded returns work, is that when the market's going up quickly, we buy these properties. Over the last few years, we've bought these properties and we see a quick bump in values because net operating income's going up, rents are going up so high, cap rates are compressing. So after a year and a half, the property is worth 30, 40, 50, 100% more than it was when you bought it. And you actually, because of the way compounding works, your compounded return, your IRR, actually drops if you hold it for longer, because you got this big bump up front. If you return the money more quickly, the way compounded returns work, the faster you return the money, the higher your compounded return is. And so there's actually a negative incentive to hold long term, because your returns would drop if you didn't sell quickly. And I think what we're going to start to see moving forward is that you're not going to be able to get any return in a year, any positive return in a year. And after 2 years, maybe you're making a little return. And after 3 years, you're making more of a return. And then by the time you get to 5, 6, 7 years, you're hitting your projections. And that's the way the market's supposed to work. You build up to your projections.
Exactly.
Exactly. And so I think LPs are going to have to get back into this mindset. And a lot of them have never been in this mindset. They're going to have to get there for the first time. They're going to have to get into this mindset that it's going to take work and there's going to be risk. And in year one, you may not get much returns. And in year two, you still may not get much returns. And hopefully if that operating group works really hard and is really smart and does everything right, by year 4, 5, 6, 7, you get your return to where it's supposed to be.
Oh, and I talk about this all the time when we're working. Look, we have a long-term strategy. So we don't plan exits. We also don't plan on things like cap rate compression. We also don't plan on just lift of rates moving up. when we're purchasing our assets. And we also don't plan on, when we say we have a time frame, it has to be executed within years. We're talking a 4 to 6 year time frame. Somewhere between then, we expect capital return through like a refi, and then we hold continuing on. And when the reason being is because we say things are going to go wrong. Like, that's how the market works. And so we don't know when those time frames should be hit, or we don't know when those turns are going to be happen. So we don't want to plan as if we do. But yet over the last 10 years, it's been like clockwork. Oh yeah, 3 years, refi or sell, and we'll get your money. And they just keep doing that. And then they build structures around it. They have floating interest. They have mandatory refis. They have to sell. And that stuff starts to fall apart. And also,
but is that in the best interest of the LPs, that strategy?
No, that's what I'm saying. Because now all of a sudden the GPs are getting caught, right? Where if this is a business, we're focusing on fundamentals, we're focusing on revenue, we're looking at the individual market, and we have a plan to achieve value that is not given by the market, but is achieved through what we're doing. That takes time. A business takes time to build and build up. And as long as the fundamentals are solid, you're adversely risked. And we have time to make it work. And what we found is the patience part, what Jay's talking about. There's no patience. We got people that are like 6 months, like, where's my distribution? Right? Don't expect a distribution for the first. If you get it the second year, congratulations. And they're like, well, I always get it first year. And I'm like, where are they getting? It's shocking to me. And then those deals, you find out, oh, well, they're either front loading capital or they're going no interest. They're doing short-term games, and the short-term games kill you. And if we can refi or sell in year 3, that's awesome. That's great. We all happy with that. It happened to work out in our favor. Everything worked out good, but that shouldn't be the plan. And 2, doesn't mean you're not an ATM. You shouldn't tell investors they're going to get distribution. They shouldn't be expecting that every single year. If you have a down year, stop distributions, fill up the coffers, and they should be on board with that.
Yeah, and we were starting to see this already. I mean, we did an episode. I was trying to find out the number and everything, but we did an episode about 6 months ago where people were already, a lot of LPs were already starting to be a little bit questioning whether their interests were aligned with the interest of the sponsors, the syndicators, because to your point, the syndicators were all about turning, right? They wanted to get their acquisition, they want to get the acquisition fee, then they want to sell as quickly as possible, because then they get the back end, they get paid on the back end. So the quicker they can flip these things, the better for their syndicator. Then they can go get another property and they can get another acquisition fee. They can increase their total number of units. This is all great for the GPs, but as an LP, you've got a great asset. Maybe you bought an incredible property at a great interest rate, a great market, a great property. They're starting to think, well, why aren't we holding this for 5, 7, 10 years or forever? Why aren't we refinancing and just keeping the property? And there was a lot of rumblings, I would say probably about 6 months ago, that they were starting to question whether the interest of the GP and the LP were aligned. And I think obviously right now, I'm starting to think maybe the GPs are starting to come back down to the LPs a little bit and be like, okay, let's make sure our interests are aligned. I think right now they're both are interested and aligned in the sense that they both want to preserve their capital, make sure they're a little bit more conservative than usual, and everybody understands that they're not going to get out in 2 years, that this is going to be more of a longer term play.
Let me give you a real world scenario here where I'm not going to name any names, obviously, but this is a structure that I saw. So someone was doing a syndication, and they were taking a $1.2 million acquisition fee for putting the whole thing together. They weren't putting any of their own money into the deal. And then they were giving the investors an 8 pref. And so most people would look at that and be like, oh, we're getting an 8 pref. That's great. I look at that structure. I'm like, that's the worst structure ever as an LP, because what is the incentive when things go wrong for that GP to battle through that investment? So let's say the GP has 5 investments that they're managing, and all of a sudden that particular property start to have problems. They have a floating rate debt, they have low occupancy, they have whatnot. So they look at their projections and they say, okay, our value of our property is now significantly lower. Our projections of what we're going to return here, we're going to be lucky if we break even and return our investors' money. How incentivized is that GP to work their ass off to get every dollar back on that when they've already got $1.2 million from the acquisition fee. They didn't put any of their money back into the deal. And they know that unless they return above an 8% return annualized or IRR, depending on how it works, back to their investors, they're getting $0 on the back end.
Yeah, and I don't know how I don't know what 1.2 million. I don't know what percentage that was from the actual acquisition cost, because obviously that makes a difference. But no, that's where I think whoever mentioned it earlier, it goes back to this idea of financial education, and you really, in my mind, to be honest with you, taking personal responsibilities in an LP. You can't just like write a $50,000 or $100,000 check and not just be like, oh, this is like, money in the bank. I'm just going to send this person $100,000. You've got to do your due diligence, and you've got to know something about it. You've got to realize that the incentive structure, you want to make sure that the LPs and the GPs incentive structures are aligned. You want to make sure they're going to, they're going to go get, yes, they need to get an acquisition fee. They're busting their butt. They're signing on the loan. They're doing all this work ahead of time. So a reasonable acquisition fee makes sense. Yeah, an asset management fee keeps the lights on, but ultimately you want the GP to really get paid on the back end along with your investors, so that they do have that incentive to do the best they can. So yeah, generally speaking, just for everyone out there, usually a sort of a 2% acquisition fee, 1.5%, 2% acquisition fee is sort of the norm. So I don't know what this 1.2, if that equated to a lot more than that or not. But obviously, if people get paid on the front end, their incentive really goes down on the back end. But you also don't want everybody to get paid on the back end, because you want them to get up and be excited to go work every day. And so you want to have them getting paid. Plus, if something ever were to happen to that management team, you want to make sure you can come bring somebody else in and there's some money in the deal already structured for them to get paid. But yeah, you want the most important thing for me anyway as an LP investor is to just make sure that my interests are aligned with the interest of the sponsors. And for me, having skin in the game is a big deal. Doesn't have to be, but for me, that's a big deal. And so if you've got no skin in the game, then if the deal goes south, there's no harm, no foul. If you've got $1 million or $500,000 in the deal and the deal goes south, you're going to lose $500,000. I feel more comfortable that our interests are aligned.
Yeah, and I think ultimately this is going to be good for the good operators out there. In fact, the more pain we see over the next couple of years, the better it's going to be for the good operators from two perspectives. One, LPs are going to get a reset on expectations. I can't tell you the number of times we get a year into a deal and I have LPs start asking me, are we selling this year? And I'm like, we're a year in. We told you this is going to be a 3 to 5 year deal, and you're already asking to sell. And then I have other LPs that are basically, well, your distribution was $100 less this month than last month. How come it was less? And they don't understand that it's not an annuity. It's not a fixed amount. It's based on the actual NOI, and we see NOIs going up and down. So number one, we're going to see LP expectations get reset, and LPs are going to learn how this is really supposed to work, this relationship between risk and reward. And then number two, we're going to see that those not so good operators are going to out themselves. Those folks that are clearly not in it to do the right thing by their LPs, the ones that don't communicate well, the ones that don't operate well, the ones that don't make good decisions under pressure. It's going to be very clear who those are. And they're either going to exit the business or they're going to have a lot of trouble raising capital. And those of us, because I'd like to think everybody here is on the good side. Those of us who are actually good at this and put our LP's interests above our own, it's going to give us an enormous opportunity because the field's going to be thinned, and we're going to be the heroes that our LPs are looking and saying, you did the right thing.
Yeah, it just occurred to me. And if you guys are watching this on YouTube, maybe drop a comment on this. But there seems to be a real need for LP sort of education or coaching that's not done by a sponsor, right? Because they always have that ulterior motive. They're teaching you how to become an LP, hoping they're going to invest in your deal. But if we can have some sort of third-party, independent, educational forum that can actually teach these kind of principles.
Why don't you do it, Mauricio?
I just wrote that down. I'm like, hey, let's start. If you guys want me to start a coaching or educational, do a YouTube channel just on how to help LPs understand, how these things work, what you should be looking at, what are the questions you should be asking your GPs. Drop a comment in there and let's take a look at it.
Well, it looks like we're trying to touch on basically preventing things from going wrong, but the fact of the matter is things are going wrong right now. And so let's talk about private placements and syndications. What happens when they start to have problems? So if a syndication or private placement has cash problems, the general partner can do what's called a capital call. It's basically asking limited partners to put a little bit more money in than their original investment to help the cash position at that time. The thing was that capital calls were so rare after, starting from 2015 when syndication became popular, and values were like always going up. Well, now they're not always going up, so we're seeing a correction in commercial real estate. I think we talked about last week or the week before that on average 15% correction. Loan rates have doubled. If you have a good attorney like Mauricio, you've always had this capital call provision in your documents, but no one really ever looked at it because it was never getting used. Well, people right now are starting to look at it. So, Jay, how are you seeing this capital call provision that was kind of just one of those line items in your legal docs? How are you seeing that get played out right now?
Yeah. So, I mean, let's start with the three big reasons we're starting to see capital calls. And I've talked about this before elsewhere, but number one, with interest rates going up, basically there's a lot of investors, a lot of operators who got floating rate debt, basically debt that's based on the interest rates. They're paying a much higher mortgage payment every month, and so there's a lot less money left over to be paying their investors and all their expenses. So that's impacting deals. Number two, any deals that are getting close to a refinance, if the property hasn't gone up in value, it might be hard to refinance for whatever you originally financed the deal for. So you may have to bring capital to the table to do a refinance. And then number three, we have these rate caps that we've talked about, these insurance policies that protect us against rates going up too high and destroying our ability to pay our mortgage. The cost of these insurance policies are going through the roof. And so if we have an insurance policy that's expiring and we have to buy a new one, we could be spending literally 10 or 20 or 30 times as much as we originally paid. I've talked about the fact that we have a property where the insurance policy that we got to protect against rate increases when we bought the property in 2020 was $30,000 a year. That same insurance policy, when it renews later this year, when we were looking at a couple months ago, was up to over $500,000. So 30,000 to 500,000, that's a big hit. And so these impacts to cash flow and the ability for deals to make money often require that, or not often, but sometimes require that operators go to their investors and say, hey, I know you put money in when this deal started. I need you to put more money into this deal. And typically in the investor documentation that investors sign, that LPs sign when they go into the deal, there's two common ways that this is dealt with. Number one, we have these things called voluntary capital calls, meaning if the operator comes back and says, hey, we need more money for this deal, we need you to put more money in, the LPs have the decision or have the choice to either put the money in or not put the money in. If they put the money in, they don't get diluted, they keep all their equity. If they choose not to put the money in, then somebody else will put the money in for them, but they'll lose some of their equity, they'll get diluted. And so that's kind of the good case. In the bad case, there are some operators that have mandatory capital calls, which means that if an operator comes and says, hey, we need more money for this deal for whatever reason, you're required to put money into the deal. And if for some reason you don't put money into the deal, you're going to get penalized, potentially up to losing all of your equity, depending on whatever the documentation says. And so make sure as an LP, I guess this is first and foremost, make sure as an LP you know what the documentation says in terms of capital calls. And if you're asked to put more money in, do you have to? Do you not have to? And if you don't, what the penalty is. But more importantly, knowing that it's possible that you're going to have to come up with money later in the deal, which means you want to keep money in a bank account separately. This has been a big issue from what I've heard for people that invest out of their IRAs. You're not allowed to take money. If you invest out of your IRA and you get a capital call and you need to put more money in, it has to come from your IRA as well. You can't put that money in personally because that becomes a legal issue with commingling funds between IRA and not. And so we're starting to see a lot of situations where operators are starting to do these capital calls. We're seeing numbers like 10, 20, 30% of your original investment in capital call. And LPs are starting to be, just like we were talking about in the last segment, are have their eyes opened or being awoken to this potential for this bad situation where they have to put in more money, where they never really intended to. Maybe they didn't know about it. Maybe they knew about it, but just didn't think it would really happen. But we're starting to see it happen.
There's always this idea that you should never put good money after bad. So I guess the question that LPs are having now is, at what point do you consider the first investment a bad investment, and what point is it just, okay, this is just a bump in the road, we have to do this to get through it, it's still a good investment, I should keep investing in it?
I want to throw out one more thing, because I was in a mastermind a couple of weeks ago with some big name investors, some very smart investors, and one of the things they were talking about was,
none of us were in that mastermind, since there was a bunch of smart guys and
the smart people, my friends.
The gamblers.
The ones he takes to New York or from California.
What a few people were talking about was this idea of doing proactive capital calls, meaning basically doing capital calls in situations where the money may have been needed but wasn't desperately needed. Basically, they didn't need to be doing the capital call yet or at that moment, but they were choosing to do it because they were concerned that other groups were going to do capital calls and LPs were going to potentially run out of money by the time they had to do a capital call. So they were doing a capital call early so that they could get access to the LP's money before it ran out.
First to the well.
Interesting. I hadn't heard that before. That's interesting.
Yeah, that's crazy. I think that when you look at, chasing bad with good, you need to understand, I guess, the future of the asset. So what is the underlying problems? Will the problems be resolved, right? And then what does that future outlook look on your new shares? So when we do like developments, like we've done, we'll do developments and we'll buy either land or we'll buy a building, and then we don't know exactly what we're going to build. So we've done capital calls to build out more. So we're like, okay, well, we got this plan, but we're going to build 50,000 more square feet, right? That's going to cost an additional $3 million. We're going to go raise. Why? Because all our returns are better. Whether you put more money in or you don't, your returns are higher, right? So it's like we want to expand. We want everybody to do more. I've never done a capital call because the deal was either in trouble or losing money or a refi or anything like that. And I think the question would be, if you're in a situation, my worry would be, if we do this, is it going to be better? So if we're doing a capital, is there going to be another one? So, or all of a sudden, is this property going to keep losing money? And now I really am chasing good money with bad, right? Or is this a bump in the road, like Kyle said? It will not only be through it, but it could even be better. And I think understanding that cash position that the company has with that asset, or that asset has, understanding if it's losing money, burn rate, if it's a one-time thing, whether it's insurance or something like that. Okay, well, are we going to make up for this? Is the NOI going to be hit in a way that our returns are even less? So having very open conversations and trying to understand that how your position will not just be affected then, just not the dollar going in, but what that dollar is being spent for. Is it going to be chasing a downward cycle and they're going to come back 6 months later and say, we need more, right? That's a position nobody wants to be in.
And how are you going to figure that out? I'm already adding to my my LP education, LP advocate stuff, because I mean, do you have? There's two components to that. Number one, do you have access to the information that you need in order to make an intelligent decision? Has the sponsor been sharing the financials and updating you, and how familiar you are with the asset? Number one. And number two, what's your level of financial education? Did I just completely say, look, hey, AJ, I know AJ, I trust him. I'm just going to give him I know I can trust AJ. I'm going to give him my money. And then if something is not going according to plan, do I have the not only the financial wherewithal, but the sort of the educational wherewithal to understand whether putting more money in is a good investment or not? So now I'm thinking maybe I'll add sort of a coaching session there and some coaching on, the analysis of the particular deal of where it is now. But and all kidding aside, I mean, that's part of it. A lot of people, we've talked about it all episode, people have just in the past have just been throwing 50 grand, 100 grand, 200. It's like money in the bank. It's an ATM. I don't have to worry about anything. I throw the money at the syndicator, and 2-3 years later, I'm getting double my money back and everything's good. Now, when you have issues and cash calls happen, do I know what's going on? Yes, there's a lot of people who do, but I also know for a fact a lot of people don't have a clue as to what they got into, what the market is, what the asset class is, what the structure is. Is this the question you're asking, AJ, is this good money after bad? How do you determine that? Do you have the education to do
Well,
that?
you got to get the person on the phone. You got to get the operator on the phone. At the end of the day, first of all, communication. If you want to talk about communication has been shit lately, and no one really cares, because if you keep getting those checks in your mailbox, then who cares if they're not communicating. So communication has been awful, but you got to get the operators on the phone. You just got to ask questions. And at the end of the day, you got to say, okay, what's the value of the property right now? And how much is our loan? If the value of the property is less than the loan right now, I don't think I'm going to put much more money in there. And then you got to ask the GP, okay, what other steps have you taken in order to before you did this capital call? Like, as a GP, like I know GPs have sold their GP shares just to get a cash infusion. That shows that they're committed to it. Giving a loan to the property. I know there's some legal issues. We got a lawyer on the line, but giving a loan to what basically, have you tried everything you can before having to make this capital call? And then you just have to get on there and you have to ask questions about, where is this money is it gonna fix it? Like, is that all you're gonna need? Like, is it just a refi? Like, do we have to do a cash in refi? It's gonna cost us 500 grand cash in, but then we're gonna have our refi. These are the new projections off of the cash flows and all that, and that's gonna fix it. Or to Jay's point he was talking about before with a rate cap, we got to buy a new rate cap. It's gonna be 300 grand. We're gonna do a small cash call. We're gonna buy that rate cap. Everything's gonna be fine. The property's still performing well. It's still hitting projections. It's just the fact that we have to buy this stupid rate cap. So it's just questions like that to make yourself feel more confident.
This was actually talked a lot about it at the Limitless event that AJ and I were at. And that is the notion that to this day, there are a lot of LPs out there that don't realize that they're wiped out. Like, the property's already gone down 20, 30%. Cap rates have gone up sufficiently enough but they don't know about it. The communication hasn't been there. Of course, is the sponsor really going to say, hey, by the way, this property's down. This property's now worth less than the loan. So I'm sorry, guys, put some more money in, but you're already negative. But a lot of the sort of the syndicators who were there at Limitless, they've been approached with deals. Hey, we need some capital infusion. Will you help us? And they're looking at these deals and saying, hey, this property is worth less than the loan. The loan needs to be written down. And by definition, those LPs are already written out and they've already been wiped out and they don't even know it. So again, it goes back to this education thing and the communication between the GPs and the LPs.
Yeah, I think, it's important too to understand. I would look at the GPs and see what they're doing. So, like, when we had the downturn, there was a lot of contraction within syndications, right? Starting last fall. And you could see within the operations what was happening. And it was some pretty big signs, right? So it was a great opportunity for us because we went out and hired a bunch of great people and increased our payroll by 35%. But you should be watching and asking. But I think it's more importantly, we're talking about what happens when it occurs, to talk about it and ask before it goes on. So what is the GP doing, right? Like, if you're going to go into a deal, what happens if there will be a capital call? What will that look like? What will the feedback be or communication till I know when that'll get to? Is it going to be dropped on me? So before you ever get into that deal, one of the things that we do is we try to keep healthy bank accounts. We try to keep healthy things, and even if that's holding off on distributions, I would rather hold off on a distribution than ever have a capital call. So what is their plan with that property as far as cash on hand? Right? So if you have a targeted revenue, what is the cash that you have sitting in accounts for maintenance, for insurance, right? For just overall accounts. If it's a down market, are they saying, hey guys, we're going to pause distributions to fill up the coffers just because we don't know? That's a good thing. You don't want your GP to be afraid of the LP, so they're just giving them money to make them happy, right? It's you want to understand, are they running good, healthy balance sheets? And is the cash flow and occupancy going in the right way? If they are concerned, are they being open with that? And are they doing the right things, like not giving full distributions? Like you can always pay it to them later. If nothing bad happens, you can always give those distributions. But don't put yourself in a position where you're out of cash.
AJ, what are the top? So let's give some value here. What are the not that there hasn't been a ton right now, but top 3 questions, AJ, that if you've been handed a cash call, the sponsor's calling you and they're saying, hey, I need another. Let's say you invested $100,000, I need another 27,500. What are the top 3 questions you think an LP should ask the sponsor before you cut that check? Put you on the spot.
Is it a one-time? So is it a one-time driven need? Like there was a mention of an insurance, right? Or was it something that happened on the property that, something broke, whatever that may be, right? Is it an ongoing issue that we need it now because of either drop in revenue, occupancy, both, right? And if it is, have those things changed and turned around? And then the next thing that I would be talking to them about is saying, are you putting money in as well?
What have you done?
What have you done? Are you putting money in as well?
Yeah. And what's the plan too? Are we just hoping that the market turns in the next 6 months to bail us out? Are we hoping that the interest rates suddenly drop a couple percentage? Or is there a plan? Let me see the plan. Does the plan make sense? And if the plan makes sense, that, hey, if everybody puts their cash call in, we'll solve this issue. And then from there, this is what we're going to do. We're going to do this. We're going to do that. We're going to lower rents. We're going to increase whatever the plan is and see if that makes sense to you.
So moral of the story is invest with AJ. He does everything right. Let's move on to the top 10. Once again, I'm going to give you guys the option as far as top 10 states people are leaving or top 10 states people are moving to. Which one do you want to hear?
What time frame? Year over year?
Yeah, this was last year. So this is based on the USPS change of address data instead of the census data, because the census data lags a little bit. So
this is not the FedEx U-Haul number?
No, this is the one with people actually changing their address. Okay, so we'll go. So I know we'll skip over the first 2 because people always know the first 2. That is Texas and Florida.
Nashville, Tennessee.
So you're throwing Tennessee on there. Tennessee, we got number 6.
Woohoo!
Is this a percentage or a total amount?
This is percentage.
Idaho
sneaks in number 10. There you go. Jay, what's your go-to?
North Carolina.
North Carolina, number 4. You guys are 3 for 3 on that. So we got Texas, Florida, South Carolina, North Carolina, Georgia, Tennessee, Nevada, Maine, Delaware, and Idaho.
Utah wasn't on the list?
Utah was not on the list.
That surprises me.
Alabama, and Colorado. Did you say Colorado?
Nope. Neither of those made the list. So better luck next year to those ones. All right, on to the fun stuff. So for our drinking game this week, I almost changed it based on our discussion, but I love this one so much. It's would you rather? Would you rather be the best kicker in the NFL or a mediocre tight end? I already did this one with Jake. That's why I know he's chuckling. And I also already know the questions that are asked. The best kickers in the NFL make around $5 million a year. Versus your average tight end makes closer to 10, so double.
Wait, say that again. The average kicker makes what?
No, the top end kickers.
Top end, yeah. What is the average? The average makes like less than $1 million, I thought.
Yeah, the top 3 kickers. I know there was one outlier, which based on the contract that made $6 million, but those top 3 they make around $5 million.
The average is 2.5. 2.5 for NFL kickers. Wow.
Okay, but that's not what I'm asking. I'm asking the best. You're the best kicker in the league, or you're just an average tight end. So you're a Zach Ertz making $10 million.
Average tight end?
You're going with average tight end?
I think the average tight end gets the ladies. So if I was single and young, I'd go with the tight end.
But you also have to think of longevity of career too, and just and hammering of your body. A kicker's not getting hit very often. They can play for a long time and they're coming out.
Yeah, but the kicker is like an outlier. Nobody wants to hang out with the kicker. The kicker's usually a loser. They all make fun of the kicker. It's a really brutal mental game for the kicker.
There you go, Jay. You're going to change your decision from last time?
Nope.
one shot and you're going to lose. Like you got to kick to make the winning field goal, and you just like one time.
But you're the best. You're the best. You're always going to have a job. You're the best at the job, and you're making those kicks.
Nobody remembers the kicker. Nobody gives a rat's ass about the kicker. Nobody gives a rat's ass about the kicker.
I'm the kicker. I'm the kicker.
I knew you were the kicker. See, the last time we did this, I was the outlier saying the tight end, where I was just like, yes, the tight end's only going to have a 5-year career and the kicker's going to have a 10 or 15-year career, but that's a hell of a 5 years.
Yeah, that's what I'm saying.
You're walking in the bar, you're 6'3" to 6'5", you're just jacked. You're going to have a lot more fun at that bar than the little 5'8", 5'9" kicker who's walking in with his 6'4" buddies.
And it's $5 million.
$5 million for 10. I mean, at what point is it just enough money?
The average kicker and punter only plays 4.87 years.
Yeah, but the average tight end makes. We're talking about the best kicker. You keep comparing it to average. We're talking about the best.
I like to compare apples to apples. I don't want to manipulate the statistics.
All right, well, what's the average tight end? 3 years then? If you want to do apples to apples, 2.5 probably.
Okay, moving on.
If you're an average, if the other problem is if you're an average anything, you're spending most of the time on the sidelines.
Well, no, I'm saying average tight end 1.
Now you're like, oh, average and top and level 1.
Oh my God, you with your caveats. You just all you want to do is criticize these things. Just lay off and play the game and have fun. Jeez. All right, we'll move on then.
He's a kicker. He's a kicker.
Yeah, he is a kicker type.
You can tell. He's that guy.
Jay, what do you want to plug? I'm not going to count your clear rum as a plug this week. You can plug something else.
I don't have anything. Going to Vegas. If anybody's in Vegas this weekend, hit me up.
Oh wow! Had you mentioned that earlier, maybe I would have made some plans to go. But apparently, I wasn't invited.
He needs some seed money for his poker tournament.
So in all seriousness, I have these 4 buddies from my tech days in California. We go out to Vegas once a year for like 3 or 4 days. We've been doing it. This is, I think, their 16th year. And so I'll be doing another Vegas World Series of Poker trip in a couple of weeks, Mauricio. So you can join me for that one.
Don't you have like a Houston property tour you want to pitch or something? Like you should be more prepared for this. This comes every week.
That's right. I agree. Aren't you doing an amazing event in September with Kyle's better half?
Yeah, but I'm waiting for it to get a little bit. I don't want to do that every week.
Okay, fair enough. We'll do it every other week. All right, AJ, plug something here. Dinosaur fossils.
Yeah, dinosaur fossils. Check out the new podcast, Saving Capitalism, should be out this week, and so yeah, check that out.
I didn't listen to your podcast last week. Did you plug this podcast on this one?
It didn't release last week. It's releasing this week.
Or did you plug this podcast in your on your other one?
Everybody goes to the podcast, listen to it, and you'll see. And then you can tell Kyle in the comments if I did or not.
Fair enough. Mauricio, what do you got?
Well, for the 7 people who are still listening, I host a Real Estate Syndicator Live every Wednesday at 4:30, and this is a breaking news. Starting next Wednesday, we're moving it to YouTube Live. So YouTube Live on the YouTube channel, Mauricio Raul. We're doing our Real Estate Syndicator Live, 4:30 Pacific time. Come join us.
You're not moving over to Twitter like Tucker Carlson?
Or Twitch. I haven't talked to Elon in a while.
Fair enough.
Kyle, what do you got? Pitch something.
Oh, yeah, that's right. I got to pitch my wife is just same as every week. Follow Badass Investor because she's just as smart as Jay, probably smarter, and she is much better looking.
No argument.
So my drink is gone. Kind of got to pee. Time to hit the head. So I will see you next Thursday.
See you guys.
Thanks, boys. We'll see you.
See ya.